Hello, my name is Malcolm Greenbaum. Welcome to this session on the new rules on relieving brought forward corporation tax losses. This measure takes effect for those losses that are incurred as from the 1st of April 2017, and the flexibility is that those certain types of those losses you'll better carry forward and then in future periods offset them against all income and gains, not only of the company that's made the loss, but also if that company has fully utilised what it can in a later year, then in that same year you can group relieve the remaining brought forward losses to other group companies. Now, a lot of companies won't have 31st of March 18 accounting period, and therefore that's going to require a bit of time apportionment or other apportionment in terms of working out the amount of the loss that arises before and after the 1st of April 17. The losses that have this new flexibility in their relief in future periods are, number one, trading losses, which previously could only be carried forward against profits from the same trade, and indeed those losses brought forward from before the 1st of April 17 still have that restriction. You can also flexibly relieve brought forward non-trading loan relationship deficits. The most common example of that is going to be where your client company has borrowed money, for example, to buy an investment or to buy an investment property. The interest expense on that loan will be a non-trading loan relationship expense, and the only type of non-trading loan relationship income a company would have would be typically bank interest or building site interest, and not very much at the moment, I would guess. And therefore, if it has this sort of excess interest expense from non-trading activity, then that creates a non-trading loan relationship deficit. Now, previously that could be carried forward against all profits apart from trading profits. So the flexibility now is that it can be carried forward against all profits, including trading profits. Thirdly, if you or your clients run an investment company, then they don't have a trade as such, and therefore their equivalent of a trade expense is a management expense. And if the management expenses exceed the taxable income, then that creates excess management expenses. Now, previously they could only carry those forward against future income, and the new flexibility means they can carry it forward against all future income and gains, and they can group relieve when they carry forward if they can't utilise those expenses themselves in that future period. Fourthly, UK property losses, rental losses, will now be able to be carried forward against all future trading profits of both the company and also going forwards any unused amounts can be used by other group companies. And finally, any non-trading losses on intangible fixed assets, which you're probably quite unlikely to come across very often, if at all. Now, it is worth noting that there will be very occasionally situations where a loss incurred after 1st of April 17 can still only be offset against future profits from the same trade. The most common example that you might come across is where the trade has deteriorated to a sort of negligible level, and therefore, of course, the expenses of running the trade are greater than the revenues, the income, and so that makes a loss. So if HMRC can succeed in demonstrating the trade has fallen to a negligible level, then any losses you incur from there onwards can only be carried forward against future profits from the same trade. Now, because pre-1st of April 17 and post-1st of April 17 losses have different methods now of loss relief, you will have to keep separate records of those separate losses. So, as we've just learned, there are 5 different types of losses that have this new flexibility, and you could have pre-April 17 and post-April 17 amounts for those 5 categories. They will ideally need to be kept separate so you know how much you used and also how much is unused and still being carried forward. And that'll make your calculations of what we call quite commonly loss memoranda, where we keep a track of the losses and how they're used. That'll make it just a lot more long-winded than perhaps it has been previously. Now, along with that good news about the flexibility of using brought forward losses, there was also a restriction introduced at the same time. So from 1st of April 2017, losses brought forward will have a restriction in the amount that can be set off in a particular future accounting period, and that limit is £5 million plus 50% of the profits and gains in excess of £5 million. Now that's a group-wide allowance, the £5 million, and therefore the group will have to allocate that allowance to companies within the group to know how much of brought forward losses get fully relieved in each particular company. Now, that restriction doesn't just apply to the new losses that get flexible relief. It'll also apply to pre-1st of April 2017 losses as well. So in larger groups with larger profits and losses, that's going to make them potentially worse off under these new rules. So for example, if you had a client that had a £6 million trading loss that was brought forward from 2015, let's say, an old loss, and they make a £6 million trading profit this year, then under the old rules they could simply offset the brought forward £6 million loss against the £6 million profit this year. Under the new rules, they are capped and they can only relieve £5 million plus 50% of the other £1 million of profit this year. They can only offset £5.5 million this year, and they'll still have to carry forward £500,000 of losses to a future period. Although, of course, they may, they'll carry forward to a future period, and that's it, unfortunately. So they're going to lose under these new rules, despite the flexibility that would otherwise be present. It's also worth noting that these new rules don't apply to capital loss. None of these new rules apply to capital losses. If a company makes a capital loss, that can still only be offset against capital gains, although there is no restriction. There's no £5 million cap on the amount of capital losses that can be offset against chargeable or capital gains. Now, it's been suggested that if you're trying to work out how to deal with all the different losses that might come along in a particular scenario, that the following approach might be suitable. So the first step will be to calculate the company's, and if you've got a group, each company's taxable profits after all reliefs, including the use of in-year losses, current year losses, and the use of group relief, current year group relief from other companies in the group, but ignoring at this stage the carry forward of losses, because that's what we're trying to deal with here, ignoring carry back reliefs from later years. Obviously, chronologically, you probably wouldn't be doing that anyway at the moment because those losses haven't yet been incurred. And ignoring any post-31st of March 17 carry-forward losses that are going to be claimed from other group companies. We're not interested in that right now. We're just interested in the basic profit for the current period, ignoring brought-forward losses. Now, we would then say, OK, fine, those are the profits in all of the companies in the group, and we know that up to £5 million of those profits can be fully relieved with brought-forward losses. And then we know that 50% of the remaining profit above that 5 million can also be relieved if we have sufficient brought forward losses as well from previous years. Now, what we would tend to do here is to try to use up pre-1st of April 17 losses carried forward in priority to post to 1st of April 17, because they can only be used against future trading profits. So the sooner we can use those up, the better. And we only want to use post-April 17 losses when we really need to, because they can be carried forward to later years and they can be group relieved, they can be offset against total profits and total gains. They're much more flexible. So the aim is to try to use pre-1st of April 17 amounts where possible first. Now, a few other points just to bear in mind while we're talking about this topic area. If in a later year we make a loss for tax purposes, for example, a trading loss, and we take advantage of the ability to carry back that loss 12 months to the previous 12 months, we don't take that carried back loss into account in working out the profits of the year we've carried back to, the previous year. In other words, we don't retrospectively reduce the ability of the company to use brought forward losses in that period. That would create a rather chaotic situation where the carryback of losses could lead to the disallowance of the use of previously brought forward losses that were set off, and they'd have to be carried forward further. It would be too many variables changing at once. Secondly, if our profit for the current year consists of both trading profits and other profits, rental profits, interest income, chargeable gains, then when we're dealing with current year losses and current year group relief, which obviously gets offset against total profits of that period, then we are required to prorata those losses against the different sources of profits. That's important because it then reduces each of those sources of profit pro rata, and that could affect the ability, for example, to use pre-1st of April 17 brought forward losses as well. Groups, if they have this £5 million allowance where we can use losses brought forward up to £5 million worth of profits in the current year, the group is able to allocate that £5 million allowance to whichever companies in the group that it wishes. That'll all have to be recorded on the corporation tax returns, but the group is allowed to allocate it as it sees fit. Finally, just to remember that the pre-1st of April 17 losses, they're still restricted in what they can be offset against. Whether they're trading losses that can only be offset against future profits from the same trade, whether they are non-trading loan relationship deficits which can only be carried forward and used against non-trading profits in the future, we've got to remember that restriction. And just remember that although they have less flexibility over future set-off, they're still subject to this £5 million restriction of set-off in any future period. Now, what principles are not going to be affected by these new rules, the cap and the flexibility? Firstly, the losses carried back. Carrying back losses to the previous period has traditionally been an effective way to relieve those losses, especially when corporation tax rates have been falling, for example. You get higher rates of relief in earlier years, but it also enables you to get a refund of any tax that was paid in those early years, which is very nice. If you've been making a trading loss, you might also be short of cash. Now, when you carry losses back to a previous period, there is no £5 million cap. Those losses are fully deductible against the total profits of that previous period. The rules for terminal loss relief haven't changed either. So if the company makes a trading loss in the final chargeable accounting period, when it ceases trading, it is still able to carry back that trading loss against its trading profits of the 3 previous years, the previous 36 months, on a LIFO basis, taking later years first. But what is a bit more complicated now is that if the company has been carrying forward post 1st of April 17 losses, the ones that have the flexible loss relief, it may have faced a cap in the amount that could be set off because of the 50% restriction on profits above £5 million. Now, if the trade then later ceases and it's still bringing forward these post 1st of April 17 losses, it hasn't had the ability, the chance to relieve them so far, then it's allowed to then carry them back against the previous 3 years prior to the final accounting period when the trade ceases, against all of that company's profits and gains, not just the trading profits, all of the profit and gains, and it doesn't have to use the 5 million restriction. After all, it's the 5 million restriction and then the 50% above that which has created probably the need to carry forward those losses to now. So if the company is now going to cease trading, we've got no opportunity to use those losses in future, you're allowed to carry them back 3 years without the 5 million restriction applying. So you might get more relief for your losses. The other principle that isn't affected, as we saw earlier, is capital losses. They're still carried forward and used against capital gains without any 5 million restriction. Now, along with this increased flexibility, there is, in HMRC's eyes and in the government's eyes, there is more opportunity for companies to try to take advantage of that flexibility by certain avoidance measures. And therefore, the government, through the legislation, has made certain changes to the anti-avoidance rules. So first of all, if a company is being purchased and it has brought forward losses, the amounts that would ordinarily be flexibly relieved, then if it joins another group, then the new group is not able to utilise those losses in the next 5 years. So it's to stop you loss buying, just buying a loss-making company so that you can leverage some tax saving out of its losses brought forward by trying to group relieve them into the new group. That will not be permitted for a period of 5 years. There have always been, traditionally, rules where there's been a major change in the nature or conduct of the trade, which we often abbreviate to McKinnocott, and there has been a change in the ownership of the company. So, for example, if I'm running a company that is selling stuff, let's say wholesale, and this company is making losses during that trading, if there's no change in ownership, but I just simply decide to change the nature of the trade. So instead of wholesaling, I'll now sell direct to customers, I'll retail, and I start making profits. It's the same trade. I'm doing the same thing. I've got a different customer base, but it's the same trade. I'm allowed to carry forward those losses and use them. However, if I sell you the company, and what the old rules just say is that if I sell you the company, and within the next 3 years, you, for example, switch from wholesale to retailing, you've now had a change in ownership and a major change in the nature or conduct of the trade. And any remaining brought forward losses from before the change in ownership, they would now be forfeited. And previously, if I change the trade from wholesale to retail, and I sell you my company within 3 years, then again, at the date of the change in ownership, at the later date, any remaining trading losses would be forfeited. You wouldn't be able to use those losses within that company. Now, we still, when we're looking at a situation where I, as the current owner, have made a major change, and I then sell you the company, we're still looking at a 3-year period. If that happens, if the change of ownership happens within 3 years of a major change, then those losses get forfeited. But if I sell you the company, and then you make a major change to the nature or conduct of the trade in the following 5 years, then any remaining losses at the date you make that major change will be forfeited. So they've extended that rule from 3 years to 5 years. And therefore, what it does in practice is to cast doubt over whether you should put a value on the trade losses carried forward when you are buying another company. If it has losses brought forward, I'd feel very reticent to pay for those trade losses. And what I might do is perhaps enter into a contingent arrangement with the vendor that if it turns out that those losses can be used, then maybe we make an adjustment to the purchase price at that time. Now, as we've seen here, there is both good news and there is bad news. The good news is the increased flexibility of the use of losses going forwards. The bad news is the cap on the amount that you can relieve in any one accounting period, the 5 million plus 50% rule. And that's going to mean that there are going to be winners and losers as a result of this change. And in fact, the government said that they expected this change in the law to be broadly tax neutral. In other words, the winners would essentially equal the losers in terms of tax saved or tax cost. So who are the winners going to be? Well, small companies and small groups of companies that are unlikely to have more than £5 million of losses or profits in a particular period, they're not going to be affected by the cap, at least not right now. So the increased flexibility will benefit them without any adverse effects. However, there's no provision in the law for the 5 million to be indexed. So over time, the effect of inflation will erode that £5 million. So more and more groups or more companies might start to have problems in years to come. The second group of winners are going to be groups that have post-April 17 losses, which would have become trapped losses because there may not be any further trade profits, for example, against which those losses can now be set. The more flexible offset will allow them to relieve some of those losses, even though they may be subject to the 50% cap. On the downside, the losers are going to be large groups primarily, where the £5 million limit is going to be a very limiting factor for the amount of brought forward losses that they can utilise. So if they have a bad trading year, for example, after April 17, then previously those losses would be just carried forward and hopefully fully relieved as soon as possible. But now with the cap, it could be that those losses carried forward will have to be relieved over many future years. Any capital intensive business or any high risk startup business that's going to make big initial losses for tax purposes, the capital intensive ones will get these huge capital allowances, potentially 100% capital allowances. That could give them a big tax loss at the beginning, and they may struggle to recover that very quickly going forwards because of the £5 million and 50% cap. Any groups that have unpredictable profit patterns, for example, where the split between trading and non-trading profit might be difficult to estimate, so it could be difficult to judge the most efficient use of the brought forward tax losses within the time limits that are available, the typically 2 years time limits. And groups and companies where there is a very variable split between trading and non-trading income, could lead to problems in relieving brought forward amounts going forwards. For most small company clients, they're likely to only ever win out of these new arrangements because of the increased flexibility. The 5 million cap is probably never going to affect them, even going forwards into the distant future. So I hope this session has given you the knowledge you need to now tackle year ends that include the 1st of April 17, so for example year end June 17, year end September 17, so that you can file corporate tax returns which optimise loss reliefs, therefore saving your clients the maximum amount of tax possible. Thank you for listening.